in Portland to restart the Coke distributorship. So if you get key person insurance, it covers you for a disaster of that kind where you can then have some money to bring in another team. Okay, buy-sell agreements between partners. I've given you the stock options, gifts, and there's a conflict between tax and value, which I'm going to share. Okay, now as a chemical engineer, if I took heavy oil and converted it to kerosene, gasoline, and jet fuel, it was an exact science. I knew exactly the size of the column, when to take off each fraction, what temperature, how to condense it, exact. Valuation is exact in its calculation, it's exact in its theory, but it has a boatload of assumptions. So if you go to two different people, you're going to get two different numbers. So that's where I think knowledge is power. Providing 9 ways of looking at a business, because you can circle the wagons and find out where it is, because it's not an exact science. So here's some reasons why. The purpose of the valuation makes a difference. Can you see when I stand over here? Yeah. Okay, the market conditions, how you compare to other companies. There's a big confusion about risk and what to use as the discount factor or the cost of capital factor. And to go to your question, both the history and projections, I believe, are very important, all right? How your business looks. Now, your management team can either be a plus or a minus or a neutral. Most people think I have a great management team, so that's a plus. Later in today, I'm going to share with you how to turn management team to a plus, all right? And then the appraiser's perspective. Okay, now there's 3 main methods. You got an asset method, and a market method, and an income method. Any appraiser is going to give you those 3 methods. Who can tell me on your balance sheet what could possibly be wrong with taking net assets minus liabilities? Is that the value of your company? So net assets minus liabilities gives you a value. Why would that not be a measure of value? Give me some reasons. Yes, sir.
Totally doesn't count for any of your future earning potential.
Obviously, there's nothing to do with operations. You've got retained earnings, and that's it. Good. What else? Yes.
Book value is not marked. I mean, the assets might be worth more if you sold them than what they show.
Perfect. So the government now is back to giving us $500,000 on Section 179. So we can actually write off $500,000. So you can buy an asset and it's immediately 0 on your books, but you just took it out of the crate. So depreciation makes for GAAP accounting, general accepted accounting principles, but doesn't do well for value. So we don't know what the value of the assets are unless we bring them to market, right? What else could be wrong? Does anybody have inventory in here? Nobody? 1 guy, 2, 3, 4. 4 inventory. How often do you count? Huh? Monthly. How about you?
It's an ongoing thing.
You ongoing? Awesome. Okay, so the premise is if I took account instantaneously, so when something leaves the warehouse, I automatically count it, it automatically comes out of my inventory, is the inventory number on my balance sheet a correct market value? Why not? Give me some reasons.
Well, they're mainly components.
Components. So they're you.
I buy them at whatever. I buy them new, and then if they sit on the shelf for a year or 2, they're.
Okay, so you could have some obsolescence, right? You could have some inventory that sits back there that doesn't turn, and also you buy at cost and sell at retail. So the value of those assets can be significantly higher if they're assembled, right, and put into a part, correct? So even though you count daily, the inventory number does not represent market. Does anybody have receivables? Okay, so receivables are great, but unless you're doing business with Adobe or GM or Westinghouse where they do 2% 10 and then pay you in about 150 days, okay, or the government, most of the time if you get receivables over 120 days, they fall into the not very collectible bin. Those occasionally are cleaned out, but lots of times they sit there. So even your receivables could be not to market. All right, my point here is, if you take assets minus liabilities and you sell or buy a business on that, it has no relationship to the value of the business. Does that make sense? It's not a metric unless you bring it up to market. Now, one of my members is the largest 18-wheeler dealer in the western United States. And they go buy different dealerships, and they buy it for their net assets. And I talked to him one day, and he says, "You guys are getting a steal, you realize that?" And they said, "Yeah, but people sell to us." Okay, and I said, okay, that's awesome. No credit whatsoever for the operations of the business. No credit for the market value of that, just whatever's sitting on the showroom floor. It was awesome. They're doing great. Don't sell your business for the assets, okay? I'm just telling you, that's not the way to do it. All right, now let's talk about what happens between revenue and net income on your P&L. This isn't a trick question. Revenue to net income, what happens? Boatloads of expenses, right? Now, we all know that privately held companies have some latitude with the gray area expenses. And so I suggest that you keep an owner's toolbox of some of those gray area expenses. I'm going to give you an example of one, okay? I own a building, and I lease the building to an operating company. Two different companies. I'm the owner of both. I can depreciate $40,000 a month rent and pay zero tax in the building. So I charge the operating company $40,000 a month. The market rent is $20,000 a month. So my operating company is writing off an extra $20,000, so what's my tax bill? It's looking good. I'm writing off extra. If you go to sell this operating company, you need to add back in the $20,000 a month to bring it to market. So if you have expenses that are not to market, you give yourself big bonuses. Those should be added back in to the cash flow, because a new owner would just be paying normal salaries. Okay, that's my add-in back, and I'll get to your other question. Okay, so let's talk about why we look at revenue multiplier first. If you take the standard deviation of EBITDA multipliers, it's way wider than revenue multipliers, because everybody books revenue pretty much accurately, all right? So we look at revenue multipliers first, and then if there's some discrepancy, we'll look at EBITDA, or we'll look at both. So most everybody's out here doing EBITDA multipliers, earnings before interest, tax, depreciation, and amortization. We look at both a revenue side and an EBITDA. We look under your NAICS codes. We look at private 60,000 private transactions. Now the key thing about this is we can look and see what the average is happening. We can see the high, we can see the low, and we get a standard deviation. So instead of on line one number, we're basically looking at 6 numbers with a range. So you give an idea of where things are happening in the marketplace. Everybody understand the difference between revenue multiplier and EBITDA multiplier? Yes, sir.
I'm just curious, what is the 60,000 private transaction database?
It's, I use Pratt Stats, and they get them from bankers and investment bankers and venture capitalists. So it's a database that you pay for to get those transactions. Okay, so this gives us a market value that's not just one EBITDA number, but I get a range of numbers. I can see what's been going on in the industry for the last 5 years, 10 years, 15 years. Does that make sense? Okay, now let's talk about the income method. Has anybody heard of the income method? That's your cash flow, discounted cash flow. Okay, who can tell me what the present value of $1 is? Thanks. You were almost up. Almost. Okay, what's the present value of $1? Has anybody heard of that term? So let's say I've decided to buy Linda's practice, her Vistage groups, for $1 million in 5 years. So I'm going to pay you $1 million in 5 years. If I look at the risk of her Vistage practice and use that as my, what I call the discount factor, taking $1 million and discount it back, depending on the risk, but let's say it's about 25%, I'm really only going to pay you about $600,000 in present value dollars. Does that make sense? So everything we do has to be brought back to today using a risk factor. It's called the discount factor. Now, to answer Paul,